Post Reg A plus liquidity is a very interesting subject for a number of reasons. Obviously, companies that use Reg A plus to list on one of the major exchanges have great liquidity, as well as the restrictions that go with being a public company. But what isn't generally known, I think, in Reg A plus is that unless your company locks your other investors, like the founders and other longer term investors, unless you lock them up, they automatically are made liquid subsequently by the Reg A plus. So there are limits on that, but the main point is that let's say you just finished your Reg A plus. The first reporting point after that, which would typically be in an unlisted company, the 6-month management financials or the annual GAAP audit. Once you've made that announcement of results, then all of the insiders are allowed to sell their securities for 2 weeks. With limits of volume, 1% of float, and there won't be much float if you're not listed anywhere. So I'm not saying this is a panacea, but the fact that those securities are liquid is very valuable, and that provides an incentive to list the stock someplace, and then it's a matter of where. If it's not going to be on the NASDAQ, where would it be? So that liquidity thing is a big advantage. It is limited in total scope, especially for the insiders, 30% a year of the size of the most recent Reg A plus raise. But the other aspect of this is that passive investors who own less than 10% of your company, who might have been in it for 6 or 8 years, they're made liquid and they're not limited by the production of financials. They're not limited by the 1% of float either. They can just go out and sell their securities unless you lock them up. So that's a really big advantage that not everyone's aware of.